please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome. You've joined us on Business Lunch. I'm Nisha Podar, and with me is my co-anchor Mangalam Malu. Mangalam, good afternoon. It's a good time as far as lunchtime is concerned because markets look fueled, closing in on the high point of the day. Remember, take a look at the Nifty 50 intraday chart as well, and that has really gained strength in the last half an hour of trade or so. And remember, this is after really opening and being below 10,500 levels today. It has fairly recovered, and overall market now looks like on the recovery path. Advanced decline also in favor of advances at this point, and some of the heavyweight counters in terms of the big results are also expected sometime soon, like State Bank of India. Mangla.
Absolutely, we'll keep an eye out on the results. A heavy day as far as results are concerned, but watch out for the global markets, because yesterday while we were underperforming, it was the Asian screen which was a buzz, and right now while we're gaining about 0.25% on all the frontline indices, the Shanghai as well as the Nikkei are absolutely flat. Mild cuts seen on the Nikkei owing to the strength in the yen. However, the Korean market as well as the Hang Seng is shut, flat, absolutely flat as far as the European markets are concerned. The only index which is gaining in Europe is the Italian index, which is up about 0.5%. Remember, there has been a lot of political uncertainty in Italy, because of which we saw that index underperforming, and now some of those losses being reversed. But let's move on. As part of our ongoing series, London Eye, Udayan Mukherjee caught up with Russell Napier of Electronic Research Interchange. Russell Napier says that he is worried about a world where something has to be liquidated to fund the government, adds that US bond yields are now looking attractive.
Through my entire investment career, really the US government has been primarily funded by foreign and local central banks. And the central bankers don't have to sell anything to buy treasuries and fund the government, they print something. And we are now living in a world where central bankers are net sellers of treasuries, and therefore it all has to be funded by savers. They could be Indian savers, by the way, they could be Japanese savers or German savers or American savers. But I worry about the level of the stock market in a world where we have to liquidate something to fund the government. That's it. Savers have two ways they can fund the US government: save more, which is bad for growth, or sell something else to buy treasuries. So I think the concern is not directly on US growth, but it's what might happen to other asset prices as they are liquidated to fund this huge supply of US treasuries. My view is that we're quite close to the peak on the US bond yield, that it's an incredibly attractive level for many investors all over the planet, obviously mainly due to the incredibly low level of yields in Japan and in the Eurozone, and therefore it will begin to attract investment. That obviously is helped by the view that I don't think inflation is a problem. So I think most people look at the 3% yield and think, well, it's...
All right, some important developments when it comes to the government's decision on oil prices. Remember, it's a double whammy with rupee depreciating and the oil prices, crude prices really going up. Some decision has to be taken this week is what is being reported by Sapna Das, my colleague, who's joining in with some important details coming in from the government sources. Tell us, Sapna.
Yeah, so in continuation with what we have reported yesterday, a very clear indication coming from top government officials that yes, measures will have to be taken together in terms of trying to stem the fuel price situation in the retail market. The rupee has played havoc. It's a bit of a double whammy, not just the rising crude, but also the impact of the rupee, particularly in the last 3 to 4 days. And keeping in mind the range of the price hikes that have been done by the OMCs. So we understand there are discussions underway at the Petroleum Ministry. Of course, finance will have its very important role to play in that on that front. But the clear understanding is that, duty reductions cannot happen in isolation. This is exactly what we have been reporting since yesterday. Having said that, so three things that need to be kept in mind. A, there are indications that an excise duty reduction may not be ruled out at this stage. Also, the fact that possibly the tinkering, if at all will happen on the basic excise front and not on the roadside. That's a smaller point to be kept in mind. But this may not be all. State governments will also have to do their bit in terms of trying to keep their VAT reductions in mind, tweaking of their VAT duties. How far that will be acceptable and practical, one never knows. It's a bit of a question mark. And of course, the other part is the fact that possibly a dialogue with the oil marketing companies in terms of how to handle the daily price revisions as far as the retail prices of petrol and diesel are concerned. what can be the mechanism, if at all, because they're completely decontrolled at the moment. So, basically fighting fire on all fronts. And of course, last but not the least, rupees again and again turning up to be a big concern as far as the impact of the rise in the oil prices is concerned. So we understand that probably some dialogue here again with the regulator. Of course, RBI will have its very strong and very clear-cut views on the same. But this is how the situation looks like. Most important, probably some decision is likely in the next 2 to 3 days, if not earlier. This is a sense we have been given as of now. But the changing situation, so we need to be flexible and alert on this front.
Fair point there, Sapna. You're talking about the words that the government is using, or the sources are telling you that the rising oil price is a crisis situation, and there has been a double whammy. So, what exactly are the indications of what the steps could be? You've spoken about states trying to reduce, or states being asked to reduce the VAT as well as excise duty, and then some hits perhaps on the PSU companies as well, the oil marketing companies. Any inkling of what direction this may go in the next 2 to 3 days?
Well, I think they will be looking at a package, probably, as I just said, all three counters will be looked at, the OMC counter, the central excise and the VAT counter, so to speak, and, concerns being flagged off on the rupee front as well. But that's, I suppose, not very much within the government's control. So, we have to see how that really pans out. Now, the most critical part over here will be that, even in terms of a duty reduction, the same question, do they have the appetite for a cut right in the beginning of the fiscal year? And, with oil prices, at least in Delhi Metro, touching almost 77, petrol, diesel, of course, is always lower. Look at the smaller metros, they're all above 80, 81, 82 rupees. So at this rate, you have to do at least 2 to 3 rupees excise duty cut.
Right.
Which means...
Sapna, we'll have to unfortunately stop you there, because Dr. Reddy's results have also just come in and the stock has really gone up. It's a positive boost for the stock, and we're just waiting for those numbers to really flash on our screens right now. The stock is up 2.5%, and Ekta is here with us. Ekta, if you already have the numbers, if you can share some details on what you make of the numbers. Dr. Reddy's Q4 revenues at 3,535 crore rupees, EBITDA coming in at 577.7 crore rupees versus the poll of 665 crore rupees. So it's lower than what we were expecting. In terms of net profit, 302 crore rupees, fairly in line, slightly below the poll of 323 crore rupees. But despite that, the stock is right now positive. So Ekta is right here. Ekta, what are your first reactions in terms of the results coming in, and what are the finer details that you want to focus on?
Well, I think it's not a bad set of numbers for Dr. Reddy's. Maybe the street was expecting it to probably be far worse. That was simply because of the kind of underperformance that we saw. It has missed our poll in terms of estimates, but I think the street was bracing itself for probably further pressure coming in on at least the revenue as well as in terms of the bottom line. So that has come around the estimates that we were working with. Yes, it's a miss as compared to what we were working with, but probably after seeing the kind of numbers that we have seen from a couple of other pharmaceutical companies, the street was probably bracing itself for something far more dramatic on the downside for Dr. Reddy's, given the fact that they were working with US pricing pressure, and given the fact that you were working with issues such as regulatory problems that they have on a couple of their plants. We're just waiting by for a we have Vishal Manchanda joining in to talk about the Dr. Reddy numbers as well, but it's important to pull up the press release as well. Margins have come in at 16 point,
details, segmental details. The pharmaceutical business, the API business, which is their core business, has seen a revenue growth of about 12% out there. The EBIT has come in at 151 crores. That compares to 54 crores. So that's a 3x move in their pharmaceutical services and active ingredients business.
That's the PSCI business that you're talking about. Not as relevant. I mean, what you really want to look at is your North America business and your India segment, and how exactly both of those did. If you can just pull that up for me, that'll be helpful. But separately, we do have the margins, which have come in at around 16.3%. Little bit of a disappointment, considering that the street was expecting it probably maintain between 17 to 18%, and that's the reason that you're seeing the stock come off from the day's high. So yes, while the numbers are largely broadly in the range that the street was working with, maybe the margin has missed.
So as far as the sales mix is concerned, Ekta, if this can really throw more light, the India business in terms of sales clients mix has come in at 17%.
So India revenue growth has been 7% year on year. North America has declined 6% year on year, declined 10% quarter on quarter.
Okay, so
Europe
it's
has declined 17% year on year.
Okay, all right. We have a couple of reactions coming in for Dr. Reddy's now. We have Vishal Manchanda joining in and Ameya Chalke. Vishal, let me come to you first. What do you sense in terms of, say, the margin picture, because that's coming at 16.3%, and the North American business, which has declined, I think, 10% sequentially?
I think this is steeper than what we had anticipated. So I think it would largely be driven by price decreases that would have been negotiated in the contracts, January contracts. So the North American decline is much steeper.
Okay.
Even other segments have not actually been able to take care of the North American decline. So this is lower than expectation.
Okay, so Ameya, were you expecting the same probably? How much were you anticipating in terms of a North America business this time round for Dr. Reddy's?
Expecting flat year-on-year growth. So this is like, I guess, 5 to 6% down year-on-year. So that is some disappointment. Maybe they are made up in other geographies like India and all. So that's why my revenue estimates are in line, basically, totally.
Okay. So if I can add, in the press release, they have written that the decline is primarily on account of higher price erosion due to channel consolidation and increased competition in some of our key molecules, and some of those have been really mentioned.
But that's exactly what's been happening in the industry in any case. We do have the breakup in terms of how they've done on a geographical basis. So North America, like we mentioned, is down 6% year-on-year, down 10% sequentially. Europe is down 17% year-on-year, down 15% sequentially. India has grown 7% year-on-year. It's flat on a Q-on-Q basis. Emerging markets is down 9% year-on-year, down 17% on a sequential basis. So really nothing has grown except for India on a year-on-year basis. So maybe that could also be a little bit of a disappointment this time. Ameya, what do you think happened with the other markets, and what was your expectation also?
So see, for Dr. Reddy, the key market would remain the US market. So even if they recover or they report good numbers in other markets, it's not, so it will not reflect in the stock price reaction, basically.
Were you expecting more for India?
So I was expecting around 590 crore in India. I guess they have done well in that segment. But it is not going to move a needle in terms of total top line, right? So the US remains the key geography for them. So even the margin decline is also largely driven by the US price erosion.
Okay. Vishal, you know, the stock is holding up around 2% odd. I know it's corrected quite significantly in the past couple of sessions, but prima facie, anything in the numbers which could be supporting the stock as well?
It's unlikely. So stock price could get supported at current levels because the reaction has already taken care of the numbers over the past few sessions. So now going forward, we'll just need to wait for whether or not the US prices are going to correct back, because there is an anticipation with growing number of discontinuations happening in the US. There is expectations. There are expectations that US pricing might correct a bit from here. So that's the next hope that we are living with for the Indian companies.
Okay. Quickly, before we wrap this up, Ameya, I just wanted a quick comment from you with regards to the margins which have come in at 16%, and what would you like to hear from the management?
So the margins may be higher on account of lower gross margins or higher R&D spend. On account of lower gross margins or higher R&D spend. However, the key monitorables which are there are basically the landscape for their three key product approvals which are expected over FY 19-20, Nuvaring, Copaxone and Suboxone. So management commentary on these products would be obviously helpful. Then obviously the Duvada inspection which is expected over next 1 or 2 quarters.
Okay. All right, Ameya, as well as Vishal, thanks very much for joining in and talking to us about the Dr. Reddy's numbers. It is most likely because of the kind of correction that we've seen that you're seeing the stock hold up. But for North America, it still continues to be quite weak. It's down 10% on a Q-on-Q basis. Compare this to around a 12% growth that they had seen in Q3 on a Q-on-Q basis. So the street was probably hoping for that kind of recovery to continue. But considering the kind of correction that we've seen, I think maybe the worst is probably already factored in. And the fact that these numbers have come in the range that maybe the street was working with on account of the entire set of numbers.
So companies also reduced their R&D expenses. I was looking at it quarter on quarter and year on year. The R&D expense
R&D can vary for a company on a Q-on-Q basis generally, but most of the companies, because of the challenges that they've been facing, some of them are contracting R&D expenditure, only focusing on specialty segments or keep molecules. Or some of them are probably just going the whole hog. It depends company-wise. But if it's not a huge fluctuation, it doesn't matter.
So the company itself is also saying, Ekta, that they've just concluded a challenging year. So it's pretty much fairly broadly in the range on the expected lines, but not that great. The margins have been disappointing, and also the US business has to be watched out very closely.
For the markets, but individual stocks, they are buzzing. The beleaguered ones, PC Jewelers are up 10%, hit a temporary freeze in the F&O market, as well as Reliance Communications up 20% from low. So we'll keep an eye out on that, but the focus will always in today's trading session be earnings. We're awaiting SBI numbers in just some time from now. So what is the street expecting? Abhishek is here with the details. Abhishek.
Well, Mangalam, the street is expecting a weak quarter for SBI owing to the fact that asset quality is expected to deteriorate. So analysts are working with a slippage number of 25,000 crore plus. So this compares to about 26,800 crore in the previous quarter. So asset quality due to elevated slippages is expected to deteriorate. Remember that gross NPA in the previous quarter was at 10.35%. Why the street is expecting a weak quarter or asset quality deterioration is due to RBI circular, which we have seen the impact on other PSU banks reporting a net loss and the highest ever net loss for them in a particular quarter. All this will come from known stress, then it is good. If they come from unknown stress, then that will be bad. So that will be bad. So if you know the known stress works out to close to 68,200 crores. Out of the overlapping, the book of stressed portfolio in SBI is about 50 to 55,000 crores. So expect the provisions to remain elevated. Provision for NPA and mark-to-market treasury loss can drive the provisions on the elevated side. While the loan growth expected to remain muted, in Q3 the loan growth was a minus 3.5% quarter on quarter, but net interest margin is expected to remain stable between 2.4 to 2.5 due to the fact that low cost deposit flow has been strong, and for SBI that ratio stands at 45% of its deposits. So NII is expected to decline by 7.5%, while net loss could actually decline by 18.5% to about 2,800 crores. Back to you.
All right. Thanks, Abhishek, for getting us that heads up. So State Bank of India in the positive zone. But remember that the overall market has also improved in terms of the sentiment in the last half an hour of trade. On to a CNBC TV 18 exclusive then. And we learned from sources that Maruti will fast track their production to meet the increasing demand and also reduce the long waiting period for the products. Utkarsh Chaturvedi joins us with all those details. Tell us, Utkarsh.
At a point of time when most of the car makers are suffering from underutilization of capacity, India's largest car maker has separate issues. Maruti at this point of time is facing excessive capacity crunch with all its best-selling vehicles in heavy demand. Now, what we are picking up is that Maruti is now planning to prepone the second phase of Hansalpur plant to October this year. Earlier, the second phase of the plant was expected to start production by January next year. Not only this, even the current plants, all the current plants are working overtime to make sure that the capacity is 100%. In fact, they're trying that if possible, there can be some more cars which can be manufactured from the same plant. For example, the Hansalpur plant's first phase has a capacity of 2.4 lakh cars, but company is trying that if they can produce 2.5 or 2.6 lakh cars from that plant. Now, why is that? Because most of the cars of Maruti Suzuki at this point of time have heavy waiting periods, whether it be the newly launched Swift, whether it be the Dzire or the Baleno and Vitara Brezza. In fact, the company was looking to meet the target of 2 million vehicles of FY20 in FY19 itself, but now it looks a bit bleak because the second phase of Hansalpur plant has not even started production. But at this point of time, time, Maruti is suffering from excessive capacity crunch, and the company is now trying its best to prepone the capacities which have to be included in the next 1 year.
All right, Utkarsh, thanks a lot for that. In the meanwhile, just keep an eye out on the markets. The Nifty is now sitting with gains of just about 13 odd points, given up about 30 points from the top, as well as the Nifty Bank, which has slipped a bit. The one that is weighing the Nifty lower in the last 10-15 minutes is HDFC Limited. The heavyweight should come up for you. That one is currently trading at the lower end of today's trading range, in fact, at the low point. So we'll keep an eye out on that. But a couple of stocks they're buzzing on to some corporate action now. Just Dial, that one gains in trade today after their fourth quarter earnings. They met estimates. CNBC TV 18 spoke with Mr. Bansal, the CFO of the company, about the performance, and where Mr. Bansal has said that the FY19 looks positive and the company's target is to meet the teens.
Overall, things look quite positive for FY19. Teens is what we are definitely targeting. And as the way things stand and as the way FY19 has started, we are pretty confident that the foundation that was laid in FY19, it would see the company turning around completely in FY19. In terms of overall EBITDA, if we see, FY18 EBITDA grew at about 50% year on year, despite substantial increase in our advertising spends. So for FY19 as well, about 20 to 23% margins are pretty easily sustainable. And if we are able to achieve the desired growth rate levels in top line, I think margins could see some expansion as well. Advertising spend, FY18 we spent about 65 crores versus 28 crores in the previous year. For FY19, again, we would want to spend something in the range of 8 to 9% of our top line.
All right, so that was about Just Dial, and markets really positive on the results as well. But another stock, Bharat Forge, which just came out with numbers just some time back, has really been slammed. In fact, is really weakening in trade again. So it's seen quite a bit of choppiness, and again going to the lowest point of the day, down 4%. So keep an eye out on that, and markets really punishing some of the stocks on the back of results as well. Bharat Financial Inclusion, that is one counter which is fairly right now is trying to recover in trades today, and we spoke to M.R. Rao of Bharat Financial, who says that the demand for loans remains high and the merger with IndusInd Bank will fructify in the next 3 to 4 months.
All loans that we have given from January 1st, 2017 are clocking at a repayment rate of 99.8%. So we've been very confident that this repayment rate would come back, the demand is not going anywhere. And we've been proven right. 80% of our portfolio comes from rural areas. And there's not much competition. Even if there's competition, 1 or 2 players, the demand-supply gap is so huge, as I said, that the demand for loans continues to be very high. Bulk of our growth is going to come from fresh customer acquisition. And the increase in ticket size is going to be an incremental contributor, where when a customer repays one loan and goes on to the next cycle, she typically tends to take a 10-15% higher loan than the earlier loan. So our growth is always based on fresh customer acquisition by penetrating deeper into rural areas. For example, I think this year we're planning to open 400-500 branches, and that will be more rural and a few new states that we have not presented. We expect the merger to happen in the next few months, 3 or 4 months. So I don't think there is going to be any need to raise capital.